Ever feel like your income's just too unpredictable for banks to take you seriously? Here's the truth. It's not your hustle that's holding you back, it's how the system sees you. So why do so many gig workers with steady gigs still get denied? Most people think it's about how much you make. But what actually matters is how you manage what you have. In the next few minutes, you'll learn how to turn your real-world grind into credit power, no matter how unpredictable your paychecks look. If you're a gig worker, freelancer, or anyone whose income doesn't arrive like clockwork, you've probably heard that building good credit is harder for you. Maybe you've even felt anxious seeing your bank balance fluctuate from month to month, wondering if lenders or credit bureaus will judge you for it. But here's the truth. Irregular income isn't the real obstacle to building a strong credit profile. Many people believe that a steady paycheck is the golden ticket to good credit, but that's simply not how the system works. Your income's ups and downs might make budgeting a bit trickier, but when it comes to your credit score, it's not the amount or frequency of your deposits that matters most. The real challenge is how you handle your credit, how you pay your bills, manage your debts, and make financial decisions day in and day out. Credit bureaus don't see your pay stubs or track your income streams. What they do see is your payment history, your credit utilization, and your ability to manage what you owe. In fact, credit bureaus are far more interested in your financial habits than your paycheck size or how regularly you get paid. They're looking for patterns of responsibility. Do you pay on time? Do you keep your balances low? And do you avoid taking on more debt than you can handle? It might surprise you, but even someone with a high, steady salary can have poor credit if they're careless with payments or max out their credit cards. On the flip side, a freelancer with unpredictable income can build excellent credit by being diligent about paying bills on time and keeping debt in check. Missing payments even just once or twice can have a bigger impact on your credit score than the size of your paycheck ever could. It's your consistency and reliability that count, not your income's consistency. So, if you're worried that your freelance or gig work puts you at a disadvantage, remember, you have the power to shape your credit future. By setting reminders, automating payments, and keeping track of your spending, you can build a credit history that opens doors. No matter how unpredictable your income may be, the credit system is designed to reward responsible behavior. It doesn't care if you're a salaried employee, a rideshare driver, or a creative freelancer. What matters is how you manage the money you have. This means your financial future is shaped by your actions, not your job title or the way you get paid. Every on-time payment, every smart financial choice, adds up to a stronger credit profile. So, let's put the myth to rest. Gig work and good credit are absolutely compatible. In fact, your flexible work style can teach you discipline and resourcefulness, qualities that are perfect for building credit. Your habits, not your income, are what define your creditworthiness. By focusing on what you can control, you can turn your financial habits into your greatest asset. Learn how the credit system works, follow a smart strategy, and you'll be amazed at how strong your credit profile can become, even with an unpredictable income. Let's get started on this journey together, and turn your financial habits into the foundation of your financial success. Your credit score is like a financial report card, a 3-digit number that can open doors or close them, depending on how you manage your money. It's a snapshot that lenders, landlords, and sometimes even employers use to quickly judge your financial reliability. Whether you're applying for a credit card, a car loan, or even renting an apartment, your credit score is often the first thing they check. It shows lenders how likely you are to repay borrowed money, and it can influence not just whether you're approved, but also the interest rates and terms you're offered. A higher score can mean lower costs and more opportunities, while a lower score can make borrowing more expensive or even impossible. Many people think your income is a big part of your credit score, but that's actually a myth. Credit bureaus don't even collect your salary information. Instead, they focus on how you handle the credit you already have, not how much you earn. So, even if you make a high income, it won't automatically boost your score. What matters most is your payment history. Paying your bills on time, every time, is the single biggest influence on your score. Lenders want to see a track record of reliability, and even one missed payment can send up a red flag. Even a single late payment can hurt your score for months, while a streak of on-time payments builds a solid foundation for your financial future. Setting up automatic payments or reminders can help you stay on track and avoid costly mistakes. Next is your credit utilization ratio. This is the percentage of your available credit that you're actually using. It's a key factor because it shows how much of your credit limit you rely on. If you're constantly maxing out your cards, lenders may worry you're overextended. For the best results, try to keep your credit utilization under 30%. That means, if you have a $10,000 credit limit, aim to use less than $3,000 at any given time. Lower is even better, as it signals to lenders that you're managing your credit responsibly. Lenders also like to see a mix of credit types on your report. This could include credit cards, auto loans, student loans, or a mortgage. Having different types of credit shows you can handle a variety of financial responsibilities. Another important factor is the length of your credit history. The longer you've had credit accounts open, the more data lenders have to judge your habits. Keeping older accounts open, even if you don't use them often, can help boost your score over time. Opening new accounts too often can lower your average account age and signal risk to lenders, so be strategic about when and why you apply for new credit. Each new account can cause a small, temporary dip in your score. Focus on these core components: payment history, credit utilization, and credit mix. These are the pillars of a strong credit score, and improving them can make a big difference in your financial life. Mastering these basics is the first step to building a score that truly reflects your financial responsibility and opens up more opportunities for you in the future. In the next section, let's break down how you can put these strategies into action and start seeing real improvements in your credit score. While your income doesn't affect your credit score, it does matter when you apply for loans. Lenders are used to steady paychecks, so variable deposits can confuse them. They might misjudge your financial stability if they only see a slow month. That's why a strong credit score is your best advocate. It proves you're reliable no matter how your income flows. Your credit report is objective proof of your dependability. Pair a great score with organized records, like tax returns and profit loss statements, to help lenders see the full picture. This shifts their focus from your income's ups and downs to your consistent payment history. A stellar credit score bridges the understanding gap and builds lender confidence. Make your credit profile the centerpiece of your financial story. The most important habit for building credit is making every payment on time. The amount doesn't matter, just that you pay by the due date. Even a small on-time payment counts as much as a large one. This is empowering for gig workers. You don't need a big income, just consistency. Use a credit card for a small, regular expense, like a streaming service, and pay it off each month. This builds a flawless payment history and keeps your credit utilization low. Focus on creating an unbroken chain of on-time payments, not on paying off all your debt at once. This simple, sustainable strategy is perfect for those with fluctuating incomes. Over time, these habits build a robust, resilient credit score. Discipline, not income, is the true measure of creditworthiness. Automation is your secret weapon for never missing a payment. Set up automatic payments for all bills that report to credit bureaus, credit cards, loans, and more. Choose to pay at least the minimum or the full balance if possible. Even for bills that don't report, like utilities, automation prevents missed payments from turning into collections. Automation acts as a safety net, protecting your payment history and simplifying your finances. You can always make extra payments manually when you have extra cash. With AutoPay, your credit health is secure, even when life gets busy. Consistency is key, and automation makes it effortless. Whether you're just starting out on your financial journey or working to rebuild your credit after a setback, having the right tools at your disposal is crucial. Building a strong credit foundation isn't about luck, it's about making informed choices and using proven strategies that work for you. One of the most accessible tools is the secured credit card. With a secured card, you make a refundable deposit that acts as your credit limit. Use the card for small, manageable purchases, think groceries, gas, or a streaming subscription. The key is to pay off your balance in full and on time every month. This simple habit shows lenders you're responsible and can be trusted with credit. After several months of consistent on-time payments, your credit card issuer may reward you with a higher limit or even offer you an unsecured card. This is a sign that your credit worthiness is improving. Remember, patience pays off. Responsible use over time is what builds your reputation with lenders. Another powerful tool is the Credit Builder loan. These loans are designed specifically for people looking to establish or repair credit. You borrow a small amount, make fixed monthly payments, and, at the end of the term, you get your money back, plus a positive payment history reported to the credit bureaus. It's a safe, structured way to show you can handle debt responsibly. Today, you can even get credit for paying your rent and utility bills on time. Services now exist that report these payments to the major credit bureaus, helping you build credit with the bills you're already paying. This is especially helpful if you don't have traditional loans or credit cards yet. All these tools work together to help you build a positive payment history, even if you're starting with a thin credit file. Each on-time payment adds another brick to your credit foundation, making it stronger and more reliable. The most important thing is to use these tools wisely. Don't overspend or take on more than you can handle. Instead, focus on making payments on time, keeping your balances low, and monitoring your progress. Over time, you'll see your credit score start to climb. Remember, it's not about how much you borrow, but how reliably you pay it back. Consistency is key. Set up automatic payments or reminders so you never miss a due date. Even small, regular payments can make a big difference in your credit profile. For the best results, combine these tools. Use a secured card, a credit builder loan, and rent or utility reporting together to accelerate your progress. Each tool adds a new layer of positive information information to your credit report, helping you reach your goals faster. Building credit isn't about taking big risks or chasing quick fixes. It's about making smart, steady choices that set you up for long-term success. Avoid high-interest loans or offers that seem too good to be true. Focus on proven, safe strategies. No matter where you're starting from, you have the power to build a solid credit foundation. Start with the tools you have, stay consistent, and watch your financial future take shape, one smart step at a time. For gig workers, stability comes from strong habits. Track your income and expenses. Use an app, spreadsheet, or notebook. Review your cash flow weekly to know what you can afford for debt payments and savings. This awareness helps you manage credit utilization and avoid overextending. Understand credit inquiries. Soft pulls don't affect your score, but hard pulls do. Check your own credit regularly to spot errors and monitor progress. Only apply for new credit when you really need it and are likely to be approved. Strategic tracking and applications protect your score. Good habits make your credit work for you. A strong credit score unlocks real opportunities. Renting, good credit gives you an edge and can lower your deposit. Buying a car, a higher score means lower interest rates and monthly payments. Dreaming of homeownership, lenders look past variable income if your credit is strong, saving you thousands over the life of a mortgage. Want to grow your business? Lenders check your personal credit before approving business loans. In every area, housing, transportation, business. Good credit is your ticket to better terms and more choices. It's a vote of confidence in your financial responsibility. Build your score, and you build your future. Credit is more than a number, it's your key to new possibilities. Building credit is a marathon, not a sprint. There are no shortcuts, just patience, discipline, and consistency. Stick with positive habits, pay on time, keep balances low, and track your finances. Your irregular income doesn't define you, your habits do. Automate payments, use credit building tools wisely, and monitor your credit regularly. These steps compound over time, leading to a score that opens doors. You're in control of your financial future. The gig economy offers freedom, pair it with financial strength. With the right strategy, you can have both a flexible career and a solid financial foundation. Be patient, persistent, and proud. Lasting credit is within your reach.